You said that China's trillion-dollar trade surplus should be a warning to not just Beijing, but the rest of the world as well. Unpack that for me. Good morning.
That $1 trillion trade surplus, Dan, is certainly an eye-popping number. And at one level, one might argue that it shows the success of Chinese manufacturers in terms of their competitiveness in world markets. But to my mind, while there is some truth to that aspect, there are two very worrying concerns here, one for China, one for the world. For China, it shows a substantial imbalance in the domestic economy. Ever since the COVID pandemic, China has sustained growth in the 5 to 5.5% range, but largely on the back of credit-financed investment and not very productive investment at that. But still, that investment has been powering growth and it has not been matched by an increase in domestic demand. So the only alternative for China then is to export all of that surplus, which it has been doing very effectively, but it means that China is now very dependent on the world for its growth. And that's the second issue, the concern for the world that the second largest in the economy in the world, rather than pulling the rest of the world along through its demand, is in fact relying on other countries in order to sustain its own growth. And the problem is that many of the countries that China has been increasing its exports to, and you mentioned some of them, are quite vulnerable themselves with somewhat weak growth prospects. And many of them are quite reliant on exports themselves. So it looks like rather than really being the engine of world growth, which China was in the aftermath of the global financial crisis of 2008, 2009, now you have China, in my view, becoming something of a drag on world growth, and that does not bode well for 2026.
Well, the question is, how much of a drag? Can we put a figure on it as well?
Well, the trade surplus gives you some intimation of that. What it basically says is that if you think about China growing at 5%, it's certainly adding to global GDP at the rate of 5%. But on the other hand, if you look at final demand, the addition is much, much lower. So in a sense, the fact that China is running a $1 trillion trade surplus means that that has to be compensated for by increased demand in the rest of the world. So that is one measure of how much of a drag China is on the rest of the world. Now, at the same time, certainly China's investment is pulling in a lot of imports, including imports of commodities and energy and so forth. But the reality is that that does not offset the amount of manufactured goods that China is exporting to the rest of the world. So in net terms, it's still a pretty significant drag.
Indeed, it also means that this surplus figure will ultimately result in more trade tensions with the United States. Imagine we're broadcasting into the Oval Office this morning, President Trump watching on. What do you think he's going to think about this trade surplus at the moment that China's seeing?
He'll probably say two things. Aha, the Chinese are at it again. But he will say that his actions, putting up large tariff barriers against Chinese exports, has at least prevented those exports from flooding the shores of the U.S. That is certainly true to a significant extent, that bilateral exports from China to the U.S. have certainly shrunk quite significantly, although there is a sense that some of those exports are now being rerouted or transshipped through other countries. So the overall indirect and direct U.S. trade deficit with China probably hasn't fallen as much as the headline figures show. But the second thing Trump is probably going to say is that other countries are likely going to start seeing things exactly the same way the US does. Because if you think about a country like Germany or Japan, both of which are not doing very well economically, those are very big markets for Chinese exports, but their own manufacturing sectors are not doing very well right now. So we've already heard a lot of European leaders, including French President Emmanuel Macron, the head of the EU, Ursula von der Leyen, all saying that they don't want to become dumping grounds for Chinese exports. The same is true of many other countries around the world, all of which certainly want to maintain good commercial relationships with China, but don't want to become what they see as dumping grounds for Chinese exports.
Exactly. So, Eswar, let's talk about the opportunity for policymakers here as well, because one of the other things that you've been talking about is how the government often, promises reform but delivers stimulus instead. How much longer do you think this model of credit-fueled investment in order to hit economic growth targets is realistically going to work. And when you take a step back here and also think about how policymakers can respond to this, what is the first order of business if you're advising anyone in the Chinese government today? What would you tell them?
So this is something I've been telling them for a long time, and they know the answers already, exactly what needs to be done. But we are at a particularly interesting juncture right now, Dan, because one of the problems with a lot of this investment is, in fact, there has been a lot of competition within China itself, and that has led to deflation within China, or at least deflationary pressures. And the Chinese government is worried about what this is doing to corporate profits and so on. They call this problem involution. So they set in place the anti-involution campaign to sort of limit competition. But that has had the somewhat paradoxical effect of causing investment to actually almost collapse in the last couple of months, although there are some questions about how correct those data are. But if investment is weakening, one might argue maybe this is going to lead some economic rebalancing. But consumption has weakened in parallel, so the imbalance is still growing. And one thing that always works for China is putting in a boost of investment to get short-term growth up. But you're right that this is going to be an increasing problem for China. It is getting less and less traction. But what interests me right now is in the latest China working at the Economic Committee meeting, there wasn't a sense of urgency that one got out of the documents that one saw coming out of that meeting. The government seems ready to move forward with both fiscal and monetary stimulus if the economy needs it, but they don't seem convinced that it really needs it. I think they need some stimulus, especially fiscal rather than monetary stimulus. But really, what is much more essential is the broader reforms that China has needed for a long time. And again, these are all mentioned in the party documents, but the government doesn't seem to be putting much emphasis on these measures in the short term. These include financial market, labor market reforms, reforms to center-state fiscal relations, dealing with the housing market problem, and so forth. So the path to to fixing the Chinese economy is pretty clear. The government knows it. But the problem is that it's not showing any seriousness in terms of pushing forward with those reforms.